Good afternoon, and welcome to Thornburg Investment Management's 2026 Outlook webinar. I'm your host, Josh Rubin, a client portfolio manager for Thornburg. A few housekeeping items before we get started. This webcast is being recorded, and a replay will be available next week. We want to keep this interactive, so I'm going to begin by asking a few questions, but please submit your questions at any time through WebEx. We'll try to get through as many of your questions as we can, but if we don't get to all of them in the allotted time, we'll follow up after the webcast. For those of you joining today who may be less familiar with Thornburg, we're an investment manager based in Santa Fe, New Mexico, overseeing approximately $55 billion of assets across a suite of actively managed equity, fixed income, and multi-asset portfolios. Joining me today is Christian Hoffman, head of our fixed income, and Matt Burdett, head of equities. Gentlemen, thank you for providing this outlook. Christian, let's start with you. In the bond world, a coupon year is what I'll call a boring year, when the environment is pretty stable, bond prices are pretty stable, and investors' total return is essentially driven by the yield on their bonds. Many strategists say 2026 could be a coupon year for fixed income. How does that align with your outlook?
You know, having seen many of these outlooks for multiple decades, I would say that the idea of a coupon year for an outlook is actually something of a tried cliche, and I think you could go back and see that that is the most consensus call almost every single year. And if you go back and look what actually occurred during those years, you would find that it's actually very rare that you get a coupon year. And you can maybe try to unpack why it is that people call for a coupon year, and I think you could think about, efficient markets theorems, and also the fact that, what just happened is maybe likely to continue to happen. So it's kind of a cop-out in a way to say that we think that interest rates are fairly valued and credit spreads are also fairly valued. And if that's the case, and if I'm not calling for a catalyst, then the future should very much like the present, and we'll get a coupon year, and we won't have a lot of volatility. So why is that usually not the case? Because the world changes, facts change, and risk appetites change, and generally we have volatility during the year, and the world looks pretty different a year forward as it did in the past. Now, as we look at credit spreads from the beginning of 25 to the end of 25, they actually ended up in a similar place, but it was far from a straight line. And if I think about client conversations that I had a year ago when credit spreads were also quite tight, a lot of folks said, well, why wouldn't you just really lean into risk? Because the outlook feels fairly subdued, and why not just clip a coupon? I don't see any catalysts coming. And we actually pushed back on that and said, well, it's pretty rare that you actually see catalysts coming, and the way you price risk in general can be a risk factor. And so if things are priced to perfection, any bump in the road is likely to cause volatility and can cause drawdowns. We saw that very much during March and April, and if you look at high yield spreads, which is a good proxy for risk in credit markets, within 2025 you saw as tight as 250 to as wide as 450, during the year, and that was a year when, looking back, not a ton changed, but certainly there were periods of time when there was a lot of fear and uncertainty in the market. When I think about how we're starting the year today, there's an old adage that markets hate uncertainty. This period of time is probably the exception that proves the rule. There's a tremendous amount of uncertainty. I think we pulled up a graph of executive actions and in the first year of the current administration, and it's really unprecedented. And every single day we're seeing pretty notable changes, on the global geopolitical landscape, on the trade landscape, in terms of how our relationships with other political powers are evolving, and we're doing that amidst the backdrop of pretty frothy valuations, not just in fixed income, but in equity markets as well. Mm-hmm. So, again, I think this is the exception that proves the rule, and I think you want to be nimble going into that, and being prepared to take advantage of opportunities, because I think this will be a year of more volatility and not less.
Okay, great. That makes a lot of sense. Definitely 2025 predictability was different than we'd felt in prior years, and the beginning of 2026 feels that way also. As you mentioned, credit spreads remain tight relative to both their recent history and their long-term history. Arguments for this are that the economy remains reasonably healthy and has a smaller mix of the riskiest types of high-yield credits within the index. Do you think spreads are appropriately priced at these levels in the context of what you just talked about?
No, I feel like spreads are priced for perfection, and we could spend an hour unpacking why that's the case, especially relative to history. You mentioned high yield. The composition of the high yield market is higher quality relative to the past, but if you actually deconstruct that and look how double Bs and single Bs are priced relative to history, they also look exceptionally tight, relative to history. Like we're flirting with 0th percentile in terms of richness, relative to history. You could also say that that argument does not apply to the investment grade market, and we saw multi-decade tights in spreads in the investment grade market, during 2025, and we're just slightly off of those levels today. You see it in many aspects of structured product as well. So you always have to be careful when people try to explain something and say, this time it's different. Sometimes that's true, but usually it's not.
Okay. We'll give you a break for a moment and transition to you, Matt. So I think for a long time we've been talking sort of about this foundational question for equity investors. Where will returns come from in the future, both from a geographic perspective or sector perspective, but also capital appreciation versus income? And 2025 was a year that looked different than a number of the years in the past. We saw international equities outperform U.S. equities last year, and although U.S. indices still provided solid returns, each region achieved the returns differently. The U.S. market has become highly dependent on some of the biggest companies. Can you talk about what you think this indicates about the health of global equity markets and the opportunity for stock picking in the U.S. and international markets going forward?
Sure. No, thanks for the question. Look, I think, investors should always ask themselves, where's the total return going to come from, right? In equities, it's earnings growth, it's multiple expansion or compression, dividend yield, and if it's a foreign stock, you have a currency impact, right? And the currency impact was, in particular, a benefit to dollar-based investors in 2025, and I think people kind of saw that diversification benefit come through. They've been told that for many years, and it hadn't really paid off. But last year, I think, was a year where that kind of shined. But there are material imbalances, I would think, in the stock markets, in particular the U.S. market, and it has to do with just rising concentration levels, right? I mean, there's numerous factors that contribute to that. One, the continued rise of passive investing. Two, the monopolistic tech companies that only the U.S. has, right? I mean, some other countries have good semiconductor companies, but the U.S. has the large, subscriber-based tech companies, right? And then the other driver is massive capital flows into the U.S., right? And on the screen, the audience can see the percentage in the U.S. market attributed by the top 25 stocks. And what you can see is from going back to 2022, that was 37%, and then it went up all the way to 51% in the U.S. In 2025. Compare that to international markets, it's kind of been 20%, and it got up to 21% in 2025. Mm-hmm. So it's not nearly the concentration in weight. And then if you look on the right-hand side of the slide, you can see the contribution of total return, which is even more extreme, right? So if you look 2024, the top 25 were 72% of the total return, mm-hmm. right? So that means that the other 475 didn't matter very much, or mattered far less, right? Mm-hmm. That's not as true in the international markets, as the slide highlights. So, equity market structure is also very different today than it was even 5 years ago, much less 20 years ago. A lot of the volume traded, especially in the U.S., is not based on perceived value of a stock. It's based on something else, mm-hmm. right? High frequency trading, quant, trend following, all of these things. And when you have an environment where there's no real disruptive force to that, you can get these kinds of extremes, that we're seeing. And, viewers can see the slide on the screen that highlights, if you go back to 2016, the international markets, which are the chart on the left of the screen, were about the same size in total market cap as the U.S. And then as the Mag 7 and this concentration in the top holdings really took off, which is what you see on the right and the purple shading, you can see that just extreme levels of differences in total market cap, over this time. And then it becomes a question of, well, okay, these are great companies. I think everybody would agree they are. And it becomes a question of what's the sustainable earnings power of these companies from here. And just based on the law of large numbers, it's harder to grow at really high growth rates when you are in a gigantic, place in terms of your earnings so far.
Sure. Okay. Yeah, that's very helpful. And I think a different type of question after 2025 is, given the strong run, is it too late? And over the last 10 or 15 years, there have been a couple head fakes from international. That usually, we sort of had a one and done type of year. And the question is, does the international strength have legs? We'll get to currency and some other things. But do you think the fundamentals or the macro environment are in a different place today compared to the last decade that can allow the strength to sustain itself?
Yeah, look, I think it's always going to be about earnings for equities, right? I mean, valuation as an argument by itself, it doesn't really work in equities. You need to have, you're buying the ownership stake in a company and you want to participate in the growth of the earnings and cash flow. We went through different periods of earnings growth where, the international markets saw greater earnings growth, like in the early 2000s when emerging markets were really coming into global investors' attention, right? And the earnings growth was higher than it was in the U.S., right? Then you enter the financial crisis. The U.S. drops interest rates to zero. Europe drops them in negative territory. Japan drops them in negative territory. And so what you end up having is a very different and repressive earnings environment, especially for international stocks, because the international index is the largest weight is financials, right? So if you remove a line item on the revenue, on the income statement, net interest income, or significantly pressure it on top of rising regulatory costs and all of these other things, you really do depress the earnings of international markets relative to the U.S. And that's what you saw during, what I would call the great manipulation period, right, of financial, central banks taking over. But more recently, what you've seen is once the normalization of interest rates happen as we come out of the pandemic, inflation surges, and central banks have to act. They kind of all act a bit late. And so, but then guess what happens? You start to normalize the earnings power of international markets versus the U.S. In a way that hadn't been seen since pre-global financial crisis. So it's definitely, and this is more structural relative. So to answer your question, it does have legs because you now have an earnings contributor from the largest sector that was a major, detractor to earnings at that time. The other element would be just around dividends and price appreciation versus dividends. The U.S. is much more dependent on price appreciation, and that's what the chart on the right shows, versus international markets where you have a little bit better mix. But since you have a better earnings backdrop, a relative earnings backdrop, it seems to me that it's a more fertile ground going forward than it would have been, so not a one and done.
Okay, yeah, and I think what we also do see is we're getting this improvement in the earnings trajectory with lower valuations as well. So the setup for earnings growth, valuations may or may not improve, but the earnings come through and you get a dividend kicker on top is a key element for driving global stocks. Christian, let's shift back to you, because one of the things on a prior chart that we highlighted is optically U.S. earnings growth looks higher than international earnings growth. But really that's because big tech is sort of growing 20% plus. A lot of the US economy is growing mid-single digits. And when you remove big tech, or maybe what you might want to call the AI economy, then the US index is growing, earnings are growing a little slower in the US than outside. So AI is not just impactful for equities, it is sort of changing some of the dynamics in fixed income. I think historically the big tech was a cash-rich part of the corporate universe, but today we're hearing more about the tech companies needing capital, needing funding. So they can't just utilize existing telecom and broadband infrastructure or third-party data centers. How are the tech giants impacting fixed income markets today as this race for AI seems to consume more and more capital each week?
So you're highlighting an interesting change in that AI has been a dominant theme and dominant driver in U.S. equity markets for a number of years now, but that had been largely absent from any fundamentals or anything that we are observing in fixed income markets. That really changed in 2025 when the investment grade market saw over $200 billion of issuance to fund the hyperscalers and related projects. Now, the interesting thing there, and you'll see some charts where you see the spreads on those names widen significantly, but the scale is very important. 4 of the 5 hyperscalers are rated A or AA and trade between 20 and 50 basis points of spread, which is almost nothing. The 5th one is Oracle, and that's a little bit more of an interesting differentiated story. Interestingly, you can buy 8-month Oracle paper and get almost 4.6% yield, and you'll get a similar yield for buying 10-year risk in the other hyperscalers. So they have all widened, but still from a very tight level. So I wouldn't say that's where the opportunity is. But if you think about that amount of issuance broadly, and we're looking for similar or even more this year, that's a lot of supply. If you think about supply and demand dynamics, that is likely to push spreads across the entire investment grade space wider, and that could create opportunities. And I think that could be the more interesting place to play as opposed to the hyperscalers in and of themselves. Now, this isn't an environment where if you think about the bad years in the energy market in the mid-teens, high yield was constructed of over 15% of those energy names, and so that was a key risk to people holding an equal weight index, and you saw a lot of carnage. So high yield remains pretty separated and walled off from the AI theme at this point. That could change over time. And again, the composition within the investment grade is still very high quality. So while some of the investment might be deemed as speculative, and we'll see, there's still strong underlying balance sheets and cash flows to support that debt, kind of irregardless of how that investment plays out. But it is interesting in that, often people say, fixed income markets lead equities. Again, this is something that, again, has been a dominant theme of equities and is now spilling over into fixed income.
Okay. So I guess within that context, if AI is an interesting or surprising inflection in investment grade new supply, but it's not worrying on its own, are there areas of the economy that do give you pause or concern as we go into 2026?
Broadly, you've heard this idea of a K-shaped recovery or a K-shaped economy or a K-shaped consumer. For a number of years, I think we've talked about, worrying about winners and losers, and in that you're seeing more dispersion and bifurcation between those themes. So this idea of a K, or things moving in different directions, I think is more and more broad-based. You're seeing that in credit markets as well, where some of the weakest companies and weakest credits are not doing terribly well, and are widening and not benefiting in this robust environment. And if you look at a lot of underlying credit trends, they're going their own direction. If we zoom out and think about the macro environment, broadly jobs are getting a little bit better, inflation's getting a little bit worse, and look, I would say this isn't everything looks great. There's a lot of things that look great, but there are cracks, and we just have to make sure that those cracks don't become fissures. And if they do, I think we'll see pretty severe repricing of risk across markets.
Okay. Matt, I'm guessing we may end up with some questions from the crowd about AI, but I'm going to hold off on that on the equity side right now. For our audience, another way to submit questions is to send an email to questions@thornburg.com. Questions@thornburg.com. But Matt, maybe while we wait for some of the inbound questions, just one other topic. So again, you started out highlighting different drivers of share price returns. We talked more about earnings growth or kind of the dividend contribution, or the valuation contribution potentially in lower valued international equities. What are some of the other moving pieces you think investors should be thinking about as we enter 2026 that could have a real impact to total returns from here?
Yeah, sure. So, going back to the initial question of do international stocks still have, a place in portfolios? And it goes back to the currency element, right? If you think about the dollar, and we have a chart up on the screen that shows the Fed's trade-weighted dollar index, which is a good index to use because it takes into account actual trading partners, right? And they re-index it when the weights change significantly enough to do so. And on the screen, you can see the purple line is the 20-year moving average, and this is going back 30 years. But so what that purple line is telling you, if you go back further, the dollar was a lot lower in those years leading up to the start of the graph there. And so the U.S. has benefited from capital flows, which has resulted in a stronger dollar. Last year, it gave back some of that. And now you have an administration, Treasury Secretary, all of the officials are kind of signaling that they would like to have a weaker dollar because they want to rebuild the manufacturing base in the U.S. So if you're a U.S.-based investor and the dollar's depreciating in your foreign stock, the stock goes up in dollar terms just standing there, right? So obviously, you're going to do a lot more thinking than that, but having that be a tailwind is something that people could think about.
Great. Maybe one other topic. I think clients or investors often will buy or sell a fund because it's outperforming or underperforming by a couple hundred basis points. From an income contribution, we see an interesting differential in yields, around the world. How do you think about that as a tailwind, or just something to incorporate into thinking?
Yeah, look, I think, again, going back to the question of where is my total return going to come from, having a reasonable dividend yield to start with is a good, front foot forward, right? And the chart that the viewers can see, for most of my career, Japan was the lowest equity yielding market, but now it's the U.S., right? And it's because prices have gone up a lot. Dividends are not as important in the U.S. as they are in other markets, and so the yields in other markets outside the U.S. are just better because it's a bigger part of just the philosophy within a boardroom to pay dividends. And what you see over time is that total shareholder return, roughly half of it is from dividends over long periods of time, but in any given shorter period, it can change a lot. Yeah. Sometimes it doesn't matter very much. Like, actually, since the global financial crisis, dividends have not really mattered very much because
for U.S. investors.
For U.S. investors, because the price appreciation overwhelmed the dividend yield. But you have other decades, other times when all of your return is coming from dividends. So I think people should probably maybe just think of it in a balanced way, and the international markets will give you that better yield to start with.
Great. Well, so why don't we shift to the questions we've been getting from the audience? And the first one comes to Christian, maybe because you were the first to speak, or because we need your view. What's your baseline expectation for the Federal Reserve's policy path in 2026?
So I think it's kind of evergreen question, right? And people are curious about the path of the Fed and the path of at least short-term interest rates. So, look, markets are looking for 1 to 2 cuts this year, and I think if you look at the data in front of us, that's pretty spot on. Now, I think if we go a level deeper, there's a couple interesting things to think about. One is Powell has just 3 more meetings, ahead of us, and where he'll be leading the Fed. And it's most likely that we have seen the last change in interest rate policy from Powell, that we're done and is on hold. That also brings, I think, an even more interesting question of who is his successor. And we keep getting teased where it's going to become any minute, and the person's been picked, and now it's maybe one or two. If you look at prediction markets today, there's two clear front runners, and the one we thought was the front runner is now seemingly mostly out of the picture. This upcoming Fed meeting, I would not be surprised actually to maybe see the announcement or some telegraphing of the potential successor lined up around that meeting. So I think the meeting in of itself is probably not likely to be terribly interesting, but the news around it could be very interesting. Mm-hmm. I think you also have to think about the world could look very different 6 months from now when you do have new leadership within the Fed. So if you do think about 1 to 2 for the year, again, I would say your base case is almost nothing for the first half of the year, but there's actually a lot of volatility and uncertainty around the second half of the year. So depending on the economic environment and the data, which we look at and the Fed looks at as well, again, in the back half of the year, you could be looking at 0, or you could be looking at 4 cuts if the world feels quite different. And, mm-hmm. and that's the framework we're using to think about the year ahead.
Okay, and so those moving pieces are another reason the call by a lot of strategists for this just to be a coupon year is pretty hard to anchor to, because
absolutely
the back half actually is a lot lower visibility than you might otherwise think.
For sure.
Matt, a different question we've heard is, okay, we understand how international equities can be interesting, but does that mean the U.S. is sort of off limits? It's just too expensive, the AI trade is just not interesting? Or do you see ways that U.S. equities can still be interesting, or there's other ways to invest in AI besides just the big 5 or 10 stocks that are being driven by it right now?
Yeah, look, I wouldn't say that the U.S. is off limits, right? It's as stock pickers, we want to find individual companies where there's a mispricing, and I think you will find that in the U.S. At the index level, it's a bit trickier for the concentration mm-hmm. Levels that we talked about earlier. Look, there's a lot of development in AI, and it's been the picks and shovels that have kind of been the big winners for stocks. Now it's about the implementation of AI and what kind of efficiencies it brings. You see some of that in companies. U.S. software companies have been hit pretty hard as a result of being perceived victims of AI, mm-hmm. right? And I think that remains to be seen whether that happens. And right now, even at this point, AI, if you want to think in binary terms, it's either 0 means that all the capital is a total waste, and 1 means it's going to be massively improved trend growth. The truth is it's probably somewhere in between, right? And so it doesn't mean you can find ways where there's mispricings and take advantage of both in the U.S. and in AI names that are unrelated, mm-hmm. To the. Mm-hmm. The names everybody thinks of as being AI plays. But
at this point, discipline can make investing in the U.S. still, very opportunistic discipline is valuable.
Absolutely, it's really about what's the path to success for an individual company, and mm-hmm. how much are you paying for it, right? So mm-hmm. so having a disciplined approach around how you pick an investment, I think can absolutely work.
Okay, we wanted to make today's webcast time efficient, so we're going to wrap it up here, but are glad to follow up with all of our listeners who submitted questions after the webcast. Christian and Matt, thanks very much for your time. And for everyone who joined, both thank you, and also if you'd like to learn more about our fixed income and equity outlooks, they're posted on our website at thornburg.com/outlook, thornburg.com/outlook. And when you log off this call, a survey will pop up, and your comments and feedback are greatly appreciated. Thanks very much.